In Chapter 5, we're going to talk about recognizing the symptoms of fraud. So our learning objectives are to understand how fraud symptoms help in detection, identify and understand accounting symptoms, describe internal controls, identify analytical symptoms, lifestyle changes, behavioral symptoms, and the importance of tips and complaints. So again, these are a lot of things that we've talked about before, but we'll talk a little bit more in detail here. And in the coming chapters, we'll see some examples about how these things play out. But the symptoms of fraud can be broken down into 6 groups. Accounting anomalies, like missing documentation, internal control weaknesses, where there's opportunity to commit fraud, analytical anomalies, where we see unusual fluctuations in accounts, relative to the past or to other financial statement accounts, or to industry data. Extravagant lifestyle, that's when employees stealing from you and now all of a sudden they're driving a new car. Unusual behavior, the employee that's stealing from you is extremely stressed all the time and irritable, as an example, and then tips and complaints, right? So an accounting anomaly. And if you haven't read the Elgin Aircraft case at the beginning of the book, go ahead and read that now. And then come back and then we'll discuss the case here. But it's an interesting case because this company, Elgin Aircraft, is self-insured for medical bills under a certain amount. And they have an employee who's responsible for paying medical bills when they become due. And what she does is she sets up 22 phony doctors and sends in fake medical bills and approves those bills for payment by Elgin Aircraft. And then she basically collects the check and then deposits it. And she's able to embezzle the money through these payments to fake doctors. And she was able to do it because she was a trusted employee, and nobody questioned what she was doing. And she had an opportunity to commit fraud because the auditors merely matched the claim forms with the canceled checks. So she created fake claim forms, and they matched, the documentation that they needed for the check to the doctor, so that there was a claim from a doctor. It was for services that were covered by the insurance plan. It was an approved doctor, and there was a corresponding check to that doctor. So that's all the auditors did, and everything looked like it was legitimate. The internal control weakness was this manager who was doing this hadn't taken a vacation in 10 years. So, people who are committing fraud don't leave, because if somebody else has to come in and do their job for a while, they pick up on it. And that's why people are always surprised when these employees commit fraud, because they'll oftentimes say, well, gosh, how could they do that? They were the most trusted employee. They never even took time off work. It's hard to believe they're always here. Well, there's a reason why they're always there. It's because they couldn't let somebody else do their job. The employees never received payment confirmations. So when you all go to the doctor and it gets covered by insurance, you usually get a letter in the mail that says, we've paid, we've paid for your medical procedure, right? And that's an internal control from the insurance company, because if the employee gets that and they hadn't actually gone to the doctor, they're going to complain and say, hey, why am I getting letters saying that the insurance has covered some of my medical procedures when I haven't had any medical procedures? So they weren't doing that. And then the new doctors that were being authorized for payment were never investigated or cleared by anybody. So nobody ever checked to see if these doctors were actually legitimate doctors. She was able to create the fake doctors, put them into the system, and there wasn't a segregation of duty where somebody else had to approve that doctor. So they followed up to make sure that was a legitimate doctor. So there were weaknesses in the internal controls that created opportunities for this manager to commit fraud at Elgin Aircraft. The analytical anomalies, where the relationship in the financial and non-financial data did not make sense. Well, there was $12 million paid to only 22 doctors over a period of 4 years. So increasingly, only 22 doctors were getting the bulk of the medical reimbursements from Elgin Aircraft. So that would have been a sign if internal audit had ever broken down, payments by doctor. The lifestyle symptoms. Well, the manager took employees to lunch in a limousine. That's ultimately how the fraud was uncovered. Was Elgin Aircraft did some work for the government, and a government auditor was there auditing Elgin, and she noticed that this manager was taking employees to lunch in a limousine. Now, the auditor wasn't necessarily concerned thinking that the manager was committing fraud. What they were concerned was that Elgin was committing fraud against the government. So he asked, and the government was actually paying for this limousine service. And so he inquired about it, and they said, no, that's just a wealthy employee who's independently wealthy who likes to treat their, the staff to lunch. Again, it should have been a red flag that why is a manager, even if the manager's independently wealthy, if they're independently wealthy, first, why are they still working there? And second, why are they spending, lavishly on other employees? And this manager lived in expensive houses, drove luxury cars, wore expensive clothes, and the explanation was that I'm independently wealthy. I've inherited a large sum of money, yet never seemed to go on vacation. Was so dedicated to the job, despite her great wealth, that she never went on vacation. So these are all symptoms that should have raised red flags to others in the organization that this manager was committing fraud. And it's hard for external auditors to come in and notice these lifestyle changes. It's employees who are most likely, who are going to be closest to the fraud, are most likely to not only notice lifestyle changes, but also behavioral symptoms. So this manager had a Dr. Jekyll and Mrs. Hyde personality. So she was pleasant one time and then irritable, the next minute. And that's when you're under stress and you feel guilty about things that you're doing. That's the type of behavioral symptoms that you exhibit. Her highs and lows have become more intense and more frequent. And the only reason that Elgin happened to be discovered was a tip from an external auditor who was concerned about some of the things that he had seen. So even though all these symptoms were there for others to see, it took an external auditor to sort of question what was going on. So common anomalies for frauds involve, for accounting anomalies, are irregularity in source documents. That's where you have source documents where you see photocopies. Like in one fraud, an employee who was charged with setting up a new division for the company was buying desks and chairs and other things. And he was taking the receipts. He would go buy a table, for example, photocopy the receipt, turn in the photocopy for reimbursement, and then take the table back to the store and get his money back. So he'd get his money back from the store and still get it reimbursed from the company because he was photocopying the source documents. So when you see an irregularity like that, right, that would be an accounting anomaly. Faulty journal entries, that's where journal entries don't balance. There's journal entries to things that don't make sense, like crediting expenses. And then inaccuracies in ledgers, where your trial balance doesn't balance, or you have subsidiary ledgers like the fixed asset list doesn't match the amount of fixed assets in the GL. Right? So again, these irregularity in source documents are missing documents, like missing receipts, missing receiving reports, stale items on bank reconciliation. So there's items that continue to be outstanding for long periods of time, don't ever get resolved. Excessive voids or credits. So there's a lot of credit memos, for example, related to accounts receivable. So they're writing off accounts receivable to bad debt, even though customers are actually paying, just the checks are being stolen. So you're seeing excessive voids or credits to show that it's been written off. Common names or addresses of payees or customers. So like in the case of the phony doctor situation with Elgin Aircraft, they have doctors that had similar addresses or similar names, should have tipped people off. Because if they're creating 22 phony doctors, they're probably using similar addresses because they need to mail the checks to addresses that this manager controlled. So a lot of them likely had similar addresses. And then you can only be so creative in the types of names that you create. And so those are anomalies there. So increased past due accounts, like your accounts receivable keep getting old and old and old, and they don't appear to be collected. But it turns out maybe the customer did pay, just the check was stolen. And then increased reconciling items, right? So if you're stealing fixed assets, so you're taking maybe the company has computers and other things for fixed assets, and you're stealing those things, and then when they go to reconcile the fixed asset subsidiary ledger to the general ledger, you put in a bunch of reconciling items on there to show that there's not a discrepancy. So there's an increase in reconciling items. Could be a concern that something's going on. We talked about alterations on documents, and that goes to the last one, which is photocopy documents. Because you could have a photocopy, and the photocopy creates alterations, or they're crossing out dates and writing in new dates, right? So Any type of alteration could be suspicious. When there's duplicate payments, obviously you're paying one thing multiple times. If there's second endorsement on checks, so you've written a check to a doctor, and then that's a phony doctor, so then the check, when it was received by the manager who approved the payment of the check, she endorsed it to herself, and then when you get a copy of when you get the canceled check back, you see that second endorsement. Obviously, that would be suspicious. Document sequences that don't make sense. So let's say that you have a vendor and you look at their invoice file and you have invoice 1, invoice 2, invoice 3, invoice 4, invoice 5 from that same vendor. Looks like you're their only customer. Well, maybe they're a fake vendor. Questionable handwriting on documents as if things were marked out and documents were altered, sort of similar approach. So if you see these types of alterations, photocopies, missing documents, documents with weird sequences, these are accounting anomalies. So this is the audit trail, and there's anomalies in the audit trail itself. There's potentially faulty journal entries. So in this example, if you see legal expense debited for $5,000 in cash, credited for $5,000, you know instinctively in the language of accounting that you paid an attorney for $5,000 in cash. Right? So you don't have to write that out as an explanation down below. It's obvious from the journal entry. But the question is, was the employee really paid? Was the attorney really paid $5,000? And what happens a lot of times is when employees steal, these journal entries leave the accounting equation out of balance. Or you see unusual journal entries where they've credited in an expense and then they debited a fixed assets, which is what WorldCom did. So they took expenses that were originally charged appropriately to expenses, but then they made manual journal entries close to the end of the quarter or year end where they just took it out and put it in fixed assets. So when you see these types of journal entries that look suspicious or potentially faulty, then that's obviously going to be a concern. So when, for example, if you steal assets, which is what most of the time embezzlers want to do, they steal cash or they steal inventory, they're going to get caught if they don't cover it up somehow. So usually what they do is they try and increase an expense. So they try and write that off to scrap, for example, if they steal inventory. So they want to debit an expense and credit the asset that they stole to get the assets off the books. And the best way to do that is to increase an expense. It's hard to decrease a liability because that's eventually going to get caught by altering liabilities because there's a third party that you're owed that money to, and it's hard to change that amount. And so decreasing liability is not a good scheme. You can't really change dividends, stock accounts, or revenues. So the debit to get the debit off the balance sheet because you took it to take that asset away, you need to debit something else. So you credit the asset like inventory that you stole, and then you usually debit an expense. So this is where employees are stealing. You're not committing financial statement fraud. Employees are stealing and trying to cover it up. So you steal an asset, but to show that asset off the books, so when they do account, it's not shown as missing. You credit the asset and then you debit an expense. And that expense could be obsolescence expense, could be scrap expense. It needs to be some expense to show that the asset's gone away. And the reason why you want to debit an expense is because debiting something else, like liabilities, like trying to artificially reduce liabilities or trying to debit revenues, is going to stick out like a sore thumb. Right? But expenses can oftentimes increase without too much concern. So common journal entry fraud symptoms, journal entries without documentary support, like in the case of WorldCom where they're crediting expenses and calling them fixed assets. There was no documentation to support what they're doing. There was just a brief explanation that this was prepaid capacity. Because it wasn't legitimate journal entry, there's no documentation that goes along with it. So when people come and do the audit, like the external auditors at WorldCom, there's no documentation to support what happened. And so it raises questions about whether this was a legitimate journal entry. So unexplained adjustments to receivables, payables, revenues, etc. Whenever you have unexplained adjustments, that's the same thing as having journal entries without documentary support. There's nothing to explain these adjustments to these accounts, which raises concerns. Right? journal entries that don't balance. That's not usually the case. Most of the time, if you're committing fraud, you go the extra step to make the journal entry balance. It's just that you make the entry balance, and so like if you steal inventory and then you write it off to scrap, so your scrap expense is going to go up. It's going to create an analytical anomaly. Obviously, if journal entries don't balance, it's going to create the trial balance to be out of balance, and then people are going to investigate that. They're going to find the journal entry. They're going to quickly find the journal entry that didn't balance without supporting documentation, and there's going to be a concern. So obviously, if they didn't balance, it'd be a major concern, but you'd have to be a really incompetent fraudster to write a journal entry that did not balance. That's more likely to get caught than if you didn't even try and cover it up. Journal entries made by employees who not normally make such entries. Again, that's the case in WorldCom, where you had management making these manual journal entries in the middle of the night and crediting an expense that looks suspicious, right? So now you have a journal entry made by management who doesn't usually make journal entries, and they made it at a weird time, and it was out of the ordinary course of business, it was in the middle of the night, and then it was there was no documentation to support what they were doing. So, yeah, and that was a journal entry that was made towards the end of the accounting period at an off time that caused internal auditors to be suspicious. So fraud symptoms related to the ledgers, right? Ledgers that don't balance. So the total of all debit balance is not equal to the total of all credit balances. That happens. Again, that's when you create faulty journal entries. Now that's, again, if you create faulty journal entries that don't balance, that's more likely to be caught than if you didn't do anything. But oftentimes you have master control account balances that don't equal the sum of individual customer vendor balances. So for example, you have an accounts receivable subsidiary ledger, the AR aging. The total on that doesn't equal the total in the general ledger. That's where you'd be suspicious when subsidiary ledgers stop balancing to the general ledger. And then to make them balance, you have to create artificial reconciling items to get those two to balance. That's where you might be suspicious. And the internal control weaknesses for fraud symptoms and internal controls, obviously lack of segregation of duties. And that's why small companies are oftentimes the companies that have the most fraud, the most employee fraud. It's because they don't have segregation of duties. They have one bookkeeper who's doing everything. And that bookkeeper is able to steal and cover it up because they have access to the assets. They steal, and then they have access to the records so they can cover it up. Right? So lack of physical safeguards, right? Obviously, you have inventory that's not kept in a locked warehouse, makes it susceptible to theft. Lack of independent checks. So again, you have one bookkeeper, there's no internal audit, nobody's following up to make sure the bank reconciliation balances, right? The owner's not doing it. Lack of proper authorization. Again, it's a small company. Management or the owner, maybe it's a dentist, and the dentist himself doesn't authorize checks, just leaves it all up to the bookkeeper. So there's no authorization process, there's no independent check, there's no segregation of duties, and the bookkeeper is able to steal. Right? Lack of proper documents and records. Again, this goes back to, you can make a journal entry and not have to provide any documentation for it. Right? And then there's no audit trail, and it's going to be an accounting anomaly. But if there's no internal control in place, nobody has to authorize and look at the documentation related to a journal entry. So one person does the journal entry, and then a separate person during segregation of duties authorizes that journal entry. So if somebody writes off accounts receivable because the check's been stolen, but they write it off to bad debt expense, and nobody has to authorize that transaction, and there's no corresponding credit memo, that's going to be an anomaly. Right? Overriding existing controls, which is the most common. Management can almost always do that, right? And that happens when you have poor internal controls and people can override what's happening. And then inadequate accounting system. So you have an accounting system that doesn't have controls in place, and obviously that's creates a lack of internal controls. So if you're a small business, the thing that you should be doing, if you're like a dentist, you're a general contractor, you're a lawyer, right? And you don't want to be, you just want to do your job as the lawyer. You just want to do your job as a dentist, and you want to hire a bookkeeper to keep your books for you, and you have no interest in or financial training. And that's what happens in a lot of these small companies. The owner doesn't want to keep the books. And so they trust somebody else to do it. Consequently, there's lack of segregation of duties. They have one person, and this position of trust, and they're able to steal. So if you're an owner of a small business, the simplest way to avoid having people steal from you, having your employees steal from you, is you should always reconcile the bank statement. So you open the bank statements and you do the bank statement reconciliation. So you need to learn enough that you can reconcile your checking account. The other thing is you need to pay checks and credit card bills, so there's always a record, right? So you always want a record. And when you pay checks and when you write checks to pay credit card bills or any other expense, you sign the checks yourself. So you require that the bookkeeper provide you with documentation, say, here's the credit card statement, here's all the items that we charge to the corporate credit card. You look at the detail, you say, yeah, these are all legitimate charges, and then you sign the check yourself, right? But if you're looking on the American Express corporate account and you're a general contractor and you see charges to Macy's and other places, you might say, well, how's that possible, right? So you're the one who has to look at the documentation related to all the checks and sign the checks yourself. So if you sign the checks and reconcile the bank statement every month, it doesn't mean that theft is impossible, but it's going to make it very difficult for your bookkeeper or others to steal from you. There's an example here of president of First Securities Company, Chicago. Then analytical fraud symptoms, unexplained inventory shortages or adjustments. So this is when you're analytical anomalies. Somebody's tried to cover it up, and you're noticing the analytical schemes, right? Like increased scrap. So if employees stealing your inventory and they're always writing it off to scrap, you start noticing that scraps increased, 10%, 20%, 100% over the last 3 years. You get suspicious that maybe this inventory is not actually being scrapped, but somebody's actually stealing it and writing it off to scrap. If it is legitimate scrap, then you also may have an internal control weakness in that you're getting bad raw materials that's resulting in a lot of scrap, and so maybe you don't have a process in place whereby you're inspecting materials before they come into the warehouse. So that may be an internal control weakness because you're not inspecting, and also may be a sign of fraud that somebody's stealing from you. So either way, this increase in scrap is going to be suspicious. But if it's not scrap, it could be an increase in warranty expense. It could be an increase in obsolescence expense. So anytime you see abnormal increases in expenses, maybe somebody's stealing inventory and writing it off to the expense to cover it up. And so that's where you see the analytical anomaly, right? When you see deviations from specifications. So when you've given a certain specification and maybe it's warranty expense, where this is what we want a warranty expense to be, and you see significantly going over that, well, maybe they're stealing, company supplies and writing it off the warranty expense. Excess purchases, so you seem to be purchasing more than you really need, or too many debit and credit memos are all going to be analytical symptoms. So your bad debt expense, you have increasingly high numbers of write-offs to bad debt expense. Customers who can't pay their accounts receivable. That might be suspicious because employees are stealing checks and then writing it off to bad debt expense. So the customers are actually paying, but employees are stealing it. So that's bad. That's a sign of fraud. If it's not fraud, then your increase in credit memos to writing off this bad debt expense could be that your employees are getting away with not paying you because you haven't done good credit checks on your employees. On your customers, or your customers are just not paying, and you need to cut them off and stop extending credit to them. So it may be a bad internal control there, or it could be bad internal controls because your employees are allowed to steal. So these are all the analytical anomalies. And again, if your employees, most of the time they're trying to steal assets. So you're going to see unusually large increases in an expense account if they're trying to cover it up, because they're almost always going to hit an expense account to try and cover it up, like scrap or bad debt expense or obsolescence expense. So you want to look at unusual fluctuations, not just across time, but also compared to others in the industry to see if your employees are potentially stealing from you. So these increased in these expenses, unusual increase in these expenses would be an analytical anomaly that somebody's stealing your assets. So you could have significant increases and decreases in account balances, ratios, or relationships, and that's what we're talking about. If employees are stealing from you and they're not writing it off, they're stealing customer checks for accounts receivable and they're not writing it off, then the accounts receivable balance is going to keep getting higher relative to sales, and that would be suspicious. You see physical abnormalities. That's where you see, it looks like there's the warehouse has been broken into, right? There's missing locks and fire alarm. Other alarms that appear to be short circuited. So cash shortages or overages, right? Whenever you see shortage, you go to count petty cash and it's not there. Excessive late charges. So you're paying your bills late. Maybe customers are stealing, like employees are stealing cash and you're unable to pay your charges, and so you're constantly late. Unreasonable expenses or reimbursements. So employees are charging personal expenses, charging them off as business expenses, and you start to see unreasonable amount of employee reimbursements, and that makes you suspicious that maybe employees are getting reimbursed for personal expenses. And then turnover, executives are turning over. And so that could be a sign that they're stealing and moving on. Also, sort of the opposite of that's true, like we talked about with behavioral symptoms, is they're never missing a day of work. So it could potentially go both ways. But like in the case of Health South, they had 5 different CFOs during the fraud period. And so why would CFOs be turning over? That's a good position. Well, maybe they're being asked to do things they're not comfortable with. So strange financial relationships, these are just some examples. Increased revenue with decreased inventory, where you can think of these things and why they might cause fraud. Right? Increased revenue with decreased receivables. So whenever you see an unusual relationship, something that you would not expect, to be proactive in fraud, you need to think, well, I'm going to consider fraud as a possibility of why this is happening. Extravagant lifestyles. So this is an example of Kay, somebody who embezzled $3 million from her employer. She had an expensive home, she had luxury cars, she had artwork that was filled with glass collections, expensive artwork. She had bought a boat, was having her yard landscape. She'd invite employees over from the company and serve lobster flown in from the East Coast. Right. So this is all extravagant lifestyle. Now they usually explain it away as I inherited the money somehow, or I had, somehow I'm independently wealthy through my husband or something like that. Well, the question always arises, well, why are you still working here, right? So, and this is not something that external auditors are normally going to pick up. This is something that internal auditors pick up. Then unusual behaviors. These are all things that you could think. Insomnia, increased drinking, taking drugs. So when you see employees who are normally irritable are all of a sudden friendly, or normally friendly or become excessively irritable, they can't relax. They don't look people in the eye. They become defensive. So all of these things, and it's not necessarily these one things. It's usually the change in behavior. Like they normally sleep fine, and now they're insomniacs. They don't usually drink, and now they're drinking. But it could be the opposite, right? They appear irritable all the time, but now they're trying to relax to cover it up. So if you see changes in people's behavior, that's when stress is probably setting in, or they're trying to cover up some other anomalies, and so they're trying to behave in a way that people won't suspect them of anything. So anytime you see a change in an employee's behavior, and it's usually a change for the negative, but a change in employees' behavior, you're going to be suspicious. Again, this is not something an external auditor can come in and pick up. This is something that other employees, are going to pick up, and they're in the best position to pick up unusual behaviors and lifestyle symptoms and point them out to maybe as a tip, as a whistleblowing tip, or to point them out to external auditors that can then follow up to see if there's some concern about fraud. And it's usually not one thing. It's an employee who's driving a new car, is becoming increasingly irritable, and scraps continue to increase. Then you say, well, I'm seeing multiple red flags. Maybe I ought to suspect fraud as the possibility. And then we've talked about the fraud element triangle, which is the theft act, the concealment, and the conversion. Right? And employees are in the best position to notice either the act itself, so they witness it, or the concealment, so they notice that there's an increase in scrap, right? That there's unusual credit memos to accounts receivable. Employees are the best position to pick this up and then potentially want to be able to give a tip to a whistleblower. So it's good to have the whistleblower hotline in that case. In case employees are picking up these changes in lifestyle, these things, they said, well, it looks like the employee reimbursements are going up quite a bit. I'm seeing this employee who's driving a new car. they seem excessively irritable, I think something's might be going on. So they want to call it in. So if you had a whistleblower hotline, then you're more likely to get tips and potential complaints. So we've talked about with tips, just because somebody gives a tip doesn't mean that it's always justified, right? So you have to take any tip with a grain of salt, but you investigate it and corroborate it with other evidence, because why would somebody give a tip that's not accurate? Lie. Well, maybe they feel taken advantage of them. Maybe they're jealous of other employees. Right? It could be that they were a part of the scheme and got cut out. So there could be other motivations than just altruistic motivations to blow the whistle. But if they do blow the whistle, like we talked about, you have to be proactive and follow up on those things, because other employees will notice if once when people start noticing, well, I blew the whistle one time, but nobody ever followed up on it. Right? And then obviously individuals should be considered innocent until proven guilty, because just you got a tip, just because you received a tip doesn't mean somebody's doing something. But it is a reason to follow up. And why do people not give tips? Well, it's pretty common to say, well, I see this person being irritable and they are driving a new car and everything they're doing is consistent with them stealing inventory, but I don't know it for sure and I don't want to cause waves and do it. Right? Or if I do it, maybe my boss is involved and I'll get fired. Right? Or maybe the person who's doing it is an intimidating character and they're scared to do it. Or they feel like, yeah, I don't want to be a snitch. Right? And so it can be hard to do to come forward. So that's why you want to make it as easy as possible in your whistleblower hotline to be as accessible as possible, so that if somebody does have something, they come out and they blow the whistle.